The IRS is closing the most powerful tax loophole in America on January 1st, 2026, and if you haven't moved your first $7,000 yet, you are effectively choosing to pay a 30% procrastination tax for the rest of your life. Ever feel like you're doing everything right with your money, but something still isn't adding up? You're working the corporate job. You're skipping the expensive lattes, yet your bank balance feels like it's stuck in a loop of permanent stagnation. Most people think the middle-class trap is about having a low income, but it isn't. It's actually a structural pathology, where every raise you get might actually be making you poorer. Charlie Munger famously called the first $100,000 a bitch. And he wasn't just being colorful, there is brutal money behind it. When you are starting from zero, you are doing 70% of the work while the market does almost nothing. It takes about 7.8 years to reach that first 100,000 if you're saving 10,000 a year at a 7% return. During those first 8 years, your money isn't helping you yet. It's just you, your discipline, and your ability to ignore the fact that your progress feels invisible. But once you cross that threshold, the math flips. The final 400,000 of your first million actually takes less time to earn than your very first 100,000. The reason most corporate professionals never hit that tipping point is a silent killer called lifestyle creep or lifestyle inflation. As your income rises, your aspirations for a better life rise with it, and suddenly, luxury goods and expensive dinners become your new normal. It's the emulation trap, the sociological drive to match the consumption of your peers, often funded by debt. We see this most clearly in how people buy cars. They lease or buy new luxury models on credit to signal status. But if you want to build a system instead of just a lifestyle, you need to follow the 24-10 rule, 20% down, a 4-year maximum loan, and your monthly payment should never exceed 10% of your monthly income. We often think of our home as our greatest asset, but for the middle class it can be a massive structural leak. In 2025, the average annual cost of just owning and maintaining a single-family home, not including your mortgage, is over $21,000. Maintenance, property taxes, and insurance can total over $500,000 over a 30-year mortgage. This is why wealthy individuals view money as a weapon, not a reward. While the middle class trades time for savings, driving across town to save $200, the wealthy buy time to compound power, spending $60,000 to automate a task that saves their team 6 hours. To stop the bleeding, you have to re-frictionize your spending in an age where AI-powered chatbots are making it dangerously easy to transact within a chat experience. Start by automating everything. Set up auto debits for savings so you are forced to spend only what is left after saving. Use the 10% rule for every raise. 10% goes to lifestyle enhancement, while 90% is weaponized for wealth building. When shopping online, always use incognito or safe mode to avoid cookie tracking that can actually raise prices on flights and gadgets based on your search history. One of the most misunderstood and underutilized tools in the current tax code is the Health Savings Account, or HSA. It is essentially a medical 401k with a triple tax play: tax-deductible contributions, tax-free growth, and tax-free withdrawals. The secret strategy is to pay for your current medical expenses with after-tax dollars. Save every receipt and let the HSA funds remain invested for decades. Since there is no time limit on reimbursements, you can pay yourself back 20 years from now after your money has experienced massive compound growth. Then there is the urgent matter of the 2026 deadline for the Backdoor Roth IRA. Proposed legislation might prohibit converting after-tax traditional IRA contributions to Roth IRAs starting in 2026, making 2025 a critical window for high earners who exceed traditional Roth income limits. If you earn more than $165,000 as a single filer, the backdoor method is your only pathway to tax-free retirement growth. You contribute after-tax dollars to a traditional IRA and immediately convert them, but you must have zero pre-tax balances in other IRAs to avoid the pro rata rule, which can trigger an unexpected tax bill. Building this financial architecture also requires a shift in how you handle your household files. Many middle-class families only maintain a financial file for the primary earner, but wealthy families strengthen their future loan eligibility by showing income in the accounts of non-working family members or homemakers. This isn't about complexity for complexity's sake. It's about making sure you are rich on paper so you can leverage that capital when you need it. You have to stop being an under-accumulator of wealth who confuses nominal ownership with actual control. Ultimately, achieving financial stability requires practicing financial mindfulness, which consists of two things: awareness and acceptance. Financial awareness is having a clear understanding of your assets and liabilities, while financial acceptance is acknowledging your state without judgment. Instead of stressing daily, you should create a monthly ritual: go to a coffee shop, treat yourself to a drink, and consolidate your accounts in one place so the process becomes pleasurable rather than painful. Wealth isn't about being perfect. It's about building a system that is smarter than your emotions. Stop focusing solely on saving pennies and start focusing on jurisdictional arbitrage and wealth preservation. The middle class obeys legal frameworks, but the wealthy weaponize them to silo risk and extract tax advantages. You don't need to wait until you are rich to think like the rich. Understanding this infrastructure is exactly how they got there in the first place. Preserving your future freedom starts with the decisions you make before that 2026 deadline hits.